and that's possible, but we are recording this so everybody can get a chance. Now, today we're going to start covering the statement of activities, as we'll see in a second. And there's really two major learning parts to today. One is to learn about the format of the statement, and the second part is to learn about the revenue recognition, because that's a key part. The statement of activities is all about recognizing revenue in a nonprofit organization. So the biggest part of this will be the revenue recognition. What we'll do is we'll first start looking at the format to see what that's all about. And let's see here. No, that's not what I want. Okay. Well, hopefully you can see this on your screen. You'll let me know if something's not clear. I'll try to keep it clear during the course of the presentation. What we're looking at right at the moment is the statement of activities, first page of the presentation. So here we go. What is the statement of activities? Well, we've seen it in class, and it's it's just a overall summary of the change in net assets. It's an explanation how the net assets change, which is net assets is basically the equity section of the financial statement, what we would ordinarily call the balance sheet. This reconciliation of change in net assets over however long a period of time we're recording the statement of activities is what it's all about. So to use the metaphor from Principles of Accounting, this is similar to the income statement. It's over a period of time. It's not static, like the statement of financial position is a picture at one moment in time. This is a picture of a moving picture of 3 months, 6 months, a year. And this is just what I just said. It's analogous to the income statement in a for-profit company. Generally accepted accounting principles will define the structure of this statement, and that's, of course, defined by our FASB. They promulgate the rules as we've learned before. And just in case you didn't know, which I think most of you do, is that taxes are ordinarily not collected on the net change in surplus or net assets. There's usually not a tax on that. Now, if we use information presented in the organization statements activities, it's a combination of information that goes to many users, but particularly the board members and the management use the statement activities to ask the following questions. And one question would be, can I see this? So I'm going to blow it up a little bit. That would have been my first question. If I had been a board member, that would have been my first question. Is I can't see it. All right. So here's the types of things we get from the statement activities, and that is there a demand for the service that we have? For-profit companies, of course, ask this as well, but in the nonprofit world, if you're not getting support, if you're not getting revenue, and we'll learn what those words are defined as, but if you're not getting either one of those two things, it may mean that the need for this type of organization is not there, and perhaps time would be better spent by the volunteers and the board members and the officers doing something different. After all, the organization is not owned by anybody, and its sole purpose is to serve the public needs. So if the need's not there, they should look into a different direction. For-profit companies do a similar concept where they're looking for need, but that need's driven by for profit. Here, the need is driven for what's good for the public. So another question would be, are the programs financially sustainable? Do they give us enough surplus to continue along without struggle and to be able to grow? Are we able to fundraise effectively or efficiently? And is our management and overhead expenses appropriate for what we're doing? Those are the kinds of questions that are used. We'll spend more time analyzing actual nonprofit statements later in the course, but it's good to get an idea of what kind of questions we really are asking now. Here's a real simplified. I don't think I could have made it any simpler, just to give you an idea that the scope of the statement is really the change in net assets. You're going to have revenue at the top. We'll have also maybe something called support, and then we'll have expenses, and then we'll say what's the difference, and the difference is the change in net assets. And in this case, this was my statement of activities when I was a young boy and I was getting an allowance from my father, $2.50 a week. And so therefore, this is what it would look like. Give me $2.50 one week. I spent $2, and I had a change in net assets of 50 cents, which I could use in the future. So at the end of the period, I had 50 cents in my pocket. Otherwise, we're going to call that net assets. Instead of money in my pocket, we'll call it net assets. All right, let's see if we can blow this up a little bit. This might get fuzzy because blowing it up tends to blur the pixels. So hopefully you can read this. I'm on a small screen. Hopefully you can read it a little bit better than I. This is the concept of the way a statement of activities will generally lay out. There are two ways to do it. This is one of the ways where we have the 3 columns of unrestricted, temporary restricted, and permanently restricted, and then a total column. We've seen this before. Another way to do it is single column. Imagine if it was all one column, and then at the bottom we summarized the totals that are otherwise in unrestricted, temporary restricted, and permanently restricted. So it would be just all the numbers. It would really be this column here, this column, without these other 3 columns at all. So these would go away entirely. You wouldn't see that at all. You would see just one column. But then at the bottom, there would be a summarization of all 3 of the net assets. There would be the summarization of the balance in the unrestricted, the balance in the temporary, and the balance in the permanently restricted. You wouldn't see necessarily the change in each column like you do here, which is why I'm showing you this way, because I think this is a better way overall to illustrate the change in net assets in the various categories, the 3 categories that we have. But many organizations do present their statements in a singular column, and then they have a schedule or statement that describes the change in net assets by the 3 major categories of unrestricted, temporary restricted, or permanently restricted. It's just a format thing. You did this in intermediate accounting. You looked at different types of presentations and formats of both this statement of income and the financial statement or balance sheet. So that's what we have here. There's more than one way to present it. Now in this column here, but let's just take a look at the titles. We've got contributions and gifts, and we're calling that revenue. We've got program service, we got grants and contracts, we got net assets released from restrictions, and we've got other revenue. So what we're going to try to do is we want to decipher how this presentation works, and in so doing, I also want to clear the deck a little bit so there's room to see what's going on as we go further. Here it's called revenue. All these categories are called revenue. Later today, we're going to distinguish between revenue and what we call support. Support would be, and we'll define it a couple times, same way, but we'll define it a couple times in order to drill it so everybody's familiar with it. Support is money given to the organization to help the organization where the persons giving the money are not actually getting anything in return. So contributions and gifts would be support. Program services would not necessarily be support. There we're getting money for producing the program for the public need of what we're all about. Maybe we're a hospital, so we're charging for that service. Maybe we're a camp for people in need. Maybe we're a daycare center for people in need. And the charges for that service is a program service. And that's revenue. That's going to be called revenue. Grants and contracts will depend on whether the grant or the contract is in expectation of receiving a service or a product. That would be revenue. Or if it's just given to help the organization produce the product or service for the public good, that would be support. And then you have another revenue, which is a catch-all. The expenses are broken down into fundraising expenses, money it costs to raise money, program services, which relate to what the organization's all about. So if the organization's education, that would be a program service. If it's a hospital, patient care would be a program service. Grants and contracts are grants and contracts given to other organizations to help what we want done. So this line item, grants and contracts, are money given by this nonprofit to another organization to help it accomplish its goal. So like a school might give a grant or a contract to others to teach their students in a different way, maybe in a webinar of nonprofit accounting. How do you like that? And then you have administrative or management, administrative in general, your typical overhead expenses. The way the columns work, of course, we've seen it, is there'll be a total for the unrestricted. We'll take the total for the total revenue and support. Normally, you'll see the words total revenue and support. You take that, you'll subtract your expenses, and then you'll get your change in unrestricted assets, and you'll do the same thing in the other categories. Normally, there are little or no expenses associated with temporary restricted or permanently restricted. That's why the illustration doesn't show anything here, but there could be, and we'll get to that later on. One thing's for sure, to the extent that money is released from any of its restrictions, what will happen is we'll take it out of the revenue and we'll move it to revenue of the unrestricted. We've seen that, but just one more time, we'll subtract from here and then we'll add to here. So to put some color to it, we'll subtract it from here and we'll add it to here. So as money becomes unrestricted and available for use in the way that the money had been previously temporarily restricted, it'll be released. And the way we'll show it released is we'll just basically we'll basically do the following. We'll take money from one category and move it over here. We'll physically move it over here. So it'll go from restriction to unrestricted in that way. All right. We're going to see this example lots of times. So moving on, let's get an idea of what some of these components are. We're going to get into the details of recognizing revenue in ways that we don't do in a for-profit company. And this will be mostly distinguishing for-profit from nonprofit. And this is like the biggest example, or one of the biggest ones, and that is donated services. In a for-profit entity, we would never dare record a intangible asset given to the for-profit company if we can't put a value on that intangible asset. So if somebody came along and, well, they wouldn't. In a for-profit entity, they wouldn't come along and just give us something for nothing. But in the event that they did, we wouldn't even bother recording it. But here in the nonprofit world, we are going to record donated service because that's what we're about. Where there's an expectation that in many nonprofit settings, people will donate services. Let's talk about it. So the accounting standards say that if there is services donated, we're going to recognize this donation. If the standards say we should recognize it, we're going to recognize it at the fair market value. And we'll record it as gift revenue. Another way of reading that, where it says gift revenue, another way of reading that is we'll record it as support revenue. That's another way of reading it. And an equal expense will be also recorded at the same time. This will come clear in just a second, so hang on. We're going to record both the revenue and the expense, so it'll be like a wash. It'll wash itself out, so there won't be any change to the bottom line change in net assets. So before we read the last line, let's try to understand what we're talking about, which would be, let's see if I can, how I do this. Is there a way to do that? Okay. I don't know if I hurt my presentation or not, but if I did, we'll come back to it. what I wanted to do is show you what we mean. If we have up here in the revenue category, let's call this revenue and support, and we show actually donated services, and let's say the donated services is accounting services donated. You, the class, worked for free for a nonprofit organization. Why? Because you believed in the cause of the nonprofit and you wanted to help it out. So what you did is you did their tax return for them, and the value of that, by just doing an analysis of what the value of that free tax return is, let's say it was $2,500. So the organization would actually record the services as a credit to donated services and put it in the statement of activities as revenue and support. And then when it comes to the expenses, what they would do is they would record the expense as the debit to that entry, accounting fees, for the same amount. And that balances it out. It balances out the entry, but it also means that there would be no change to the bottom line. So even though we're recording the value of these donated services or products, we're recording an equal amount as an expense on the other person's side. So the net effect when it comes to the change in net assets is zero change. That's one of the reasons why we get to do that. That works real well, except for one thing. Suppose the value, or suppose the actual donation of assets is, let's say, just to make the number look a little better, we'll call the category, in this case, donated building. I don't think that's what I meant. I meant donated building. So, and I've actually been on a board in a nonprofit organization where this is exactly what happened, and it turned out that the value of what we got was, I think, roughly in that amount, $2.5 million. And according to generally accepted accounting principles, we recognize the donation based on the fair market value of the donated building, and that went in revenues and support. But on the statement of activities, it's not like we had an expense for that amount. So there was no expense for that amount. The $2.5 million went where? Where did it go? And I'll throw this open for anybody to answer. Where did we put, if this was the credit here, and this was the credit, where would we put the debit for this building in the books and records? What account do you think you would call it? And Joan, are you there? Maybe she. Anybody? Well, if it's not an expense, it goes where? That's exactly right. Assets, and in particular, an asset we'll call building. 4. So in this kind of situation, there is a change to the bottom line because the offsetting debit does not go to the expense, it goes to the assets. All right, but that's reflecting the reality. The reality is that it is a building, it is an asset, but eventually we will wind up moving this asset in a way that will zero out the bottom line over time. How will we do that? What are we going to do? Don't guess. Ah, you guessed. Okay. I see. You got. So through depreciation, through whatever number of years it takes, the actual amount winds up getting expensed through depreciation. And that's the whole concept of why FASB at some point eventually said, nonprofits should depreciate their assets. It's not just for this reason, but this was a primary reason for making that as part of the generally accepted accounting principles for nonprofits. So even though it went in the initial year that it was donated, the building affected the bottom line, over time, the bottom line will wash out. And that works good. Let's see now. That's not what I wanted. Okay, so let's go back to the presentation. I wonder if I thought there was a way to get back. Oh, I see. Joan, you did a good job. You went to the chat room. That's good. Sorry I missed that. I'll look for that next time. That's very good. If you're on the phone, you can just charge right in, but that's okay. All right, let's try this. Let's see. Let's go back to our presentation. We'll have to get back to the page where we were at. So that's donated services. Let's just take a look at that a little bit more before we move further, which is donated services recognizes both the revenue and expense, as it says there. So usually there's no change in the net assets, and if there is, it gets taken out through time, through depreciation. One thing that we wrote here that's very important is to note that the services donated are not tax deductible. So just in case you're thinking, oh, that's a great idea, let me donate my services, I'll get a tax deduction. The tax law does not allow that because otherwise things would get out of hand. What's my time worth versus someone else's time? And I could say I was donating my whole life to a charity and get a big tax deduction. So that's just not a practical way to run the tax code. We love people who volunteer and donate things, don't get me wrong, but you can't give them the benefit of the taxes. So here's an example of some of the things that can get donated. A computer programmer's time to help an organization, a carpenter, a lawyer, an accountant. You get the idea. There can also be donated. There can be donated goods such as furniture, car, and the building, as we discussed, and they're going to be recorded as gifts or support at the fair market value on the statement of activities. They may not always show up on the statement of activities as an expense. They might show up as an asset. Depends on the situation, the facts and circumstances. If you wouldn't mind muting your phone if you're talking in the background or people are talking in the background, that would be a good thing. Okay. All right, now we're going to move forward. Grants and contract revenue. It's first, it's recorded as restricted because that's the nature of a grant. A grant will say, this is how to use money. Contract revenue will say, this is how we want you to use the money. So it first goes in as restricted revenue, and then when it's spent according to the way it's supposed to be spent, then it'll be released from the restricted revenue column, or it'd be perfectly acceptable that it's temporary restricted. That's the idea, and it would move over to the unrestricted. Notice also that with grants, particularly from the government, if they're over $500,000, they're subject to a special type of an audit, what's called a single audit or an A133 audit for the book that's describing the audit principles and standards to be used. That's the A133 is put out by the government accounting office. And those audits are done by CPAs, naturally speaking. All right, so why do we have this convoluted manipulation of the statement of activities where we have these three columns? And the reason goes back to what we described in one class, the fund accounting principle, where it allows the organization to better keep track of what's restricted, how it's restricted, when it's not restricted anymore, by maintaining these buckets, if you will, buckets of the permanent restrictions, the temporary restriction, for whatever they are. And remember, although the columns in our statement of activities is a listing of many different could be many different types of restrictions, so many different types of funds could be recorded. We summarize them in a total on the actual statement of activities, and then in the footnotes we will describe in more detail what the organization is doing with its temporary restricted assets. What do they have? What are they comprised of? What comprises the temporary restricted, and what comprises the permanently restricted? That'll be in the footnotes. And of course, we've got expenses, and they'll be listed using the accrual basis of accounting. That's pretty much an established principle in nonprofits, is that we do use the accrual basis. Just like accrual basis would tell us, we would record it when there's an obligation to pay. Standard principle, no change there. So the expenses are recorded in the books and records in the same principles that they are in for-profit entities. There is a difference between the way that the nonprofits record their activity, however, of the expenses, and that difference is to be described in just momentarily. Let's go through, well, this is the beginning of it. What we're really describing here is what we call, the presentation is, I was trying to get somewhere here. Let's see if it works. It's not working the way I thought it would work. Yeah, it's not working. Okay. Let me try a different way. Hold on. Okay. So what we do in the statement of activities is we are listing expenditures through what we call functional. Oh, I see why. Okay, now we can do this. Functional listing. Functional meaning, what's the function of the expense? What's the function of the expense? Let's get an illustration with the first example here. Fundraising is also often called organization development because what is its real purpose is to raise money from donors. That's organizational development, growing. That's the idea. Now, inside what would be fundraising expenses or organizational development could be salaries for fundraisers, could be rent for structures where we rent to have a fundraising activity, could be food for the fundraising activity. It could be supplies, could be contracts for outsiders to play music. You name it, you describe any type of fundraising activity that you've ever attended, you can imagine the different types of expenses that are involved. But what we do for the statement of activities is we summarize all those different types of expenses, which show up in different categories inside the general ledger, different accounts inside the general ledger, but we summarize it all by its function, and the function was to fundraise. So even though there are a variety of different accounts in the chart of accounts that are related to the fundraising activity, we summarize them all and call it fundraising expenses, and so the summarization is by the function of those expenses. When those expenses would have been listed as to exactly what they were in the books and records, meaning to the types of accounts, like for example, maybe there was a phone charge for the fundraising, maybe there, as I said, maybe there was salaries to a fundraiser, maybe there was supplies, maybe there was food, which you can't see because I ran out of room there, but you get the idea. It could be that there's a bunch of different types of expenses that are getting summarized by their function, fundraising. So the presentation of the statement activities when it comes to the expense side is by function, but this description that we're showing you here is the classification of what we call in the nonprofit world the natural classification of the expenses. What is it? Naturally, it's the phone, it's the salary, it's the supplies, it's food. So the natural classification is not shown in the statement of activities, but it will be shown somewhere else. It will be shown in a different statement or schedule so that the reader can see, well, how much did you spend on phone and where did you allocate that to? That's not part of the statement of activity, so we'll be getting to that at a later time. The main thing to understand is that the statement of activities is summarizing a bunch of different types of general ledger accounts into the functional aspect of what those expenses were for. How you do that, that's where the fun comes in. All right. Program service expense is also very similarly being listed by its function. So it's another functional presentation, part of the statement of activities. All the statement of activities is really by function. So program service expense is all the different categories of expense to render the activity that the program, the nonprofit, is all about. Let's just stick with a simple example: Boy Scouts of America. Let's get little kids, big kids, medium-sized kids from the elementary school all the way through high school. Let's get them together on weekends for good activities, learning activities, adventure. That would be healthy adventure. That sounds like a good idea. Keep those young boys off the streets so that they become better people, learn moral lessons in life, learn ethics. So when they go to business school, they're already ahead of the game. And so art's our program. We're bringing boys together to teach them moral, good living. And to do that, well, we need an accountant, we need transportation to get the boys, we need clothing for them, we need food for them, we need counselors, we need unit leaders. There's all kinds of different expenses that we'll have in the general ledger, in the chart of accounts. But those particular expenses that relate to the program of bringing the boys together and teaching them things and getting them to have a good time, all those expenses that go into that program, into that function, will be listed as a total. So the total, so the detail of the total will not be listed on the statement of activities. In fact, we might have more than one program service line item in a statement of activities. Very, very possibly would have more than one because we have more than one function. So we might have a program service expense for the Boy Scouts. We might have one for the Girl Scouts. That makes sense. We might have one for weekend retreats. That might be a different type of program service. So however we view the different types of services and of programs we give to the public, that's how many different listings we might have in the statement of activities. Management, administrative, and general, it's referred to as overhead, and these are the expenses that we could not make functional. We couldn't find a place to put them. They were really they were so far removed from being able to be classified in a functional area, so they wind up under a general overhead category called management, administrative, and general expense. MA&G or MG&A, management, general, and administrative, whatever you want to call it. There's a catch-all phrase, and that'll be listed on the statement of activities. And again, similar to the functional expenses that we just learned about, like program services or fundraising, the details, the natural classifications, the phone, the rent, the salaries, the utilities, the accounting fees, the lawyer fees, whatever they might comprise that's part of the overhead, those won't be listed here. They'll be summarized and put into this one category. And here's an example of the things I've been talking about, just so you catch it. These are the many expenses that would be on the general ledger. So this slide is just basically telling you what the statement of activities does, which is provides information about the expenses by their functional classification, not by their natural classification. Now, there's an interesting part to this slide, which is describing what we just talked about, the natural classification of salaries, rents, utilities, etc. Certain organizations, which are called voluntary health and welfare organizations, they do have to have a statement or a schedule showing the natural classification of those expenses. So they do have to disclose that. Whereas in other nonprofit organizations, they don't have to do that, but they can. Now later in the course, we're going to talk about whether or not the FASB has changed that. FASB has been toying with changing it that everybody will record their expenses by two ways: one by the functional classification and one by the natural. So we're going to learn that the FASB has made this change. So we'll find that all organizations, so you don't have to learn the slide right now about you don't have to worry about the voluntary health and welfare, because we're going to learn that all organizations must now record both as functional and as natural. And they're not done in one statement, they're two different statements. And the reason for that is because readers, at least in the minds of the FASB, are not just interested in the function of your expenses, but exactly how much salaries did you have. Let's see it. What? And also show it to me. Show me your natural expenses in a way where I can see how you did the classification to the various functions. That's what the this statement on natural classification of expenses is going to show me. How did you group it? What did you group? How much? Tell me how you did it. Don't hide behind accounting tricks on how you allocate expenses to the different functions. Show me what you did. And that's in the interest of this transparency that we're living in now. Now, on this note, we're going to be doing this more as we go along. We're going to be starting to delve into the new changes, and here's certainly one of them, which is that under the, now this list it says proposed, but it is now final, it's now official, and that is, let me point out the key here. The key is that now, when it comes to the statement of activities and the what we're going to call the statement of financial position, we're not going to list all three of the categories: unrestricted, temporary, and permanent. We're going to combine the three into two. Certainly, unrestricted continues to be called unrestricted, but it'll have a new name. It'll be called net assets without donor restrictions. And that new name makes it a little bit more clearer to even a non-accountant as to what it means, which is just like it says. And I guess that's the beauty of what FASB's done here, is that the new name really does say exactly what it is. They are net assets of the organization that are without donor restriction. That will be, as opposed to, and it's beautiful if you think about it, that it just really makes everything a little bit easier for the non-accountant to understand and read, is it'll be one category, net assets, you guessed it, with donor restrictions. Inside that category is just really a combination of the two columns we have today, temporary and permanent. We'll continue to have in the books and records temporary restrictions and permanent restrictions. Endowments aren't going to go away. They'll continue to be there, but now we'll actually record, or we'll present the two, the temporary and the permanent restricted, in one column, just calling it net assets with donor restrictions. And in the notes, there'll be plenty of material for someone to read to get an idea of what's in there, what's in those two categories. More about that as we go through the course. We're going to hit this over and over again because we're in this transition phase. All right, this was supposed to be a wonderful example to read, except it's probably too blurry. Let's see if I make it big on my screen. You can do it. And let's try to make it less blurry so I can read it where I am. My screen is just too small for it. You should be able to go through this and get an idea of what we've talked about so you can see it. The purpose of this presentation is not just to only see what we've talked about with some real numbers, where we show the three columns as they've been in the past, and you can sort of imagine in your mind's eye two columns for temporary and permanent instead of separating. We can just imagine all in one column. It won't make much of a difference in learning the presentation. The purpose of this is to show how do you do a statement of activities where you have 2 years in comparison. And the way you do it is you show three columns in the statement of activities for the functional expenses and the revenue and support categories by their broad titles. and you summarize that by the three categories, the three columns, and then your most current year, you take the total and you show that the total of those three columns. But then to show the comparative year, you don't bother showing all three columns, you just show the total as it was for the prior year. That's how FASB is endorsing showing more than 1 year at a time. This whole concept of showing more than 1 year at a time in, quote, an income statement or statement of activities for the nonprofits is a big, big thing. It's a big thing for profit world. It's a big thing in the nonprofit world to make our statements more meaningful by showing the trends by in a glance by having more than 1 year on our financial statements. So that was the purpose of that particular slide, to show you how you might do that. Okie dokie. Let's see. Let's go further. Oh, going further. Okay, so let's see if we can do this. If you have, I don't know if this works outside, I should work. If you have a smartphone, what you can do is you can go to socrative.com, and I'll set you up for an R.H. Smith room, and you can practice answering this question and see how you do. And I can get to see how you do out of all the number of students here. I'm sure there's a reason for it, but we can get some practice with these questions. So if you're watching the recording, what you should do is take a good, real effort at answering the question. You won't be able to do the Socrative at that time. You have to do it live, but if you're here live with us, why don't you play along and put it on socrative.com on your smartphone device and take it. And it should be up and ready for you to put an answer in. So I'll wait a second or two. And David, if you wouldn't mind, you don't. All you see is the screen with the question. You can't. When I flipped my computer to the Socrative, you don't see that, correct? So I won't be able to share the. I'll tell you what the responses are. I won't be able to illustrate it. There is a way to do it, but it will be. All right, we've got 5 listed, and we have 2 students who answered. So somebody's sleeping. More than one person. Okay, now we're getting somewhere now. So if you get a chance, I'll give you a couple more seconds. All right, let me see how you're doing. So the majority of the students here have said the answer is being B, and B is correct, because what we're showing is the revenue and support for resources received by the nonprofit. It's not revenue or support. It's not may be classified as revenue or support. Answer A. That's a little deceiving. It's B. Must be classified as revenue and support. More on that later. Let's try another one. Entities that receive public contributions or the equivalent should report expenses using which of the following? A. Functional classification. B. Natural. C. No classification. I need to set up Socrative.com for a new question, so give me a second. And now you can answer that question. It's all set up for you. So is it, if you are receiving public contributions or the equivalent, must you do functional, must you do natural, or you're not required? And we've got a lot of students answering already. Very good. Everybody answered A. A is correct. Functional is the word. All right, let me set up your Socrative for another question. I think we got one more. Let's go to the next one. Here we go. Expenses should be summarized on the statement of activities by which of the following? So this is a little bit different language than we've been talking about, but see if you can figure it out. Expenses should be summarized. That's a key. All right, we're got a little bit of a difference of opinion on this one. So let me tell you what this one is. Although we do have almost a majority, not quite, for answer C, program service and support, and that's exactly right. So it's program service and support is the statement of activities. That's how the expenses should be summarized. Again, functional, not by the natural classification. All right, not too bad. I'll set Socrative up again because I think we got maybe one more to go. Yeah, here's another one. What is the difference between total revenue and support and total expenses for a non-for-profit called? I see the question, so hold on. Is support equivalent to overhead? In the question before this, let's answer this question first, and I'll go back and take a look. So in this one, we've got half going for A and half going for C. And we have one more student who could answer and then maybe decide which way we're going. Okay, so we had a student answer C. Let's see what that does. That puts the majority at C, and that's not right. Okay. The answer here is the difference between total revenue support and the total expenses is called the net change. Answer A. Change in net assets. That's what that is. It's not an excess or deficiency, although on a level it is an excess or deficiency, but it's not called that. It's called a change in net assets. You may not like it, but that's what they call it. Okay, I'm going to clear the deck. I think we have another question coming up. Let's see. Here we go. Nope, we'll have more questions later. All right, so you can hold your smart devices aside for a minute or two. And let's go back to David's question. Is support equivalent to overhead in last question? So let's see. This is the question I think you're referring to. Let me see if I can read it. Expenses should be summarized by program and support. Yes, that would be correct. Support would be considered an overhead category in terms of expenses. So that's a good question. Good question. All right. Back to live at the ranch. So not-for-profit entities, the income statement does not provide for financial statements for the funds that a non-for-profit may maintain. Instead, it requires the non-profit to provide a statement of activities that shows activities of the entity as a whole. So it's not funds. It doesn't show all the funds that they might be recording if they're using fund accounting. They provide a statement that shows the entity as a whole, combining activities, combining the funds, I should say, would be more to the point, combining the funds into the big categories of unrestricted, temporary, and permanent. Then you would, within the body of the statement of activities, you might indicate some of the programs that they do and program revenue from those particular programs if that's applicable. But it could be that they're doing their program services all with support, as opposed to program revenue. It all depends on the type of entity, the type of organization, what it's doing. It all depends. Oh, now I knew we had something coming up. So here's another question. Let's see what we got. At the beginning of the year, if the beginning of the year net assets balance is corrected during the year by a direct entry, so we're going to learn something new here. See what you can do with this. Use your accounting thinking logic at this stage of the game. If the beginning of the year net asset balance is corrected during the year by a direct entry in the books, the effect is a cause to require a statement of changes in net assets, or described immediately following the line increase, decrease in net assets, not shown, or to be disclosed by a note. So again, we didn't just cover this, but let's learn a fact by trying. And how you could learn by trying is see how well you remember how to do in intermediate accounting. We had something called what did we call that? We had a prior period adjustment, where the opening retained earnings was being changed by something we changed in the prior period, but we did it in the current year. So if you think about how that was shown on an income statement, to see if there's a equivalency to answering this question. Let's see how you're doing. And you're doing terrible. Everyone's so far everybody's answered D. So if you haven't answered it, one or two it didn't answer, you're going to give it a shot for something else, since answer D is not it. And we're not doing too good on this one, sorry to say. Okay, so it's described immediately following the line increase, decrease in net assets, sort of close to where we put prior period adjustments down below the net revenue, the net operating revenue, the net revenue after discontinued operations. Then we put it sort of really down near the bottom, and that's the same thing here. It'll be described immediately following. It'll have its own line called but the line will describe it as, I won't use the word prior period adjustment necessarily, but it'll use correction for, it'll just say what it was. All right, well, we've learned something new. Hopefully we'll see an example of that somewhere along the line, so we won't forget it. We'll come back to it. All right, moving right ahead. A non-for-profit organization will normally recognize revenue from dues over the period to which the dues pertain. This is for an entity that has dues that they charge for its members. A nonprofit can have members, and they will normally recognize the revenue from over the period to which the dues pertain. And to record this as revenue, you have to know where any of the part of the dues are refundable, and whether goods or services are provided in exchange for payment of dues. Again, this is revenue recognition rules for the nonprofit, so let's try to dissect what this is talking about. Let's read it again. Non-for-profit will normally recognize revenue from dues over the period to which the dues pertain. So someone says, I am going to be paying dues for, here's my membership for a year. So we'll recognize it in that year. That's easy. Here's my membership dues for this year. I'm paying my dues annually. So that gets recognized all in the year that the dues are pledged or received. Remember, we're on an accrual basis. So if a member says, I'm going to pay my membership dues this year, but just 1 year, it just says I'm going to pay it, then we'll accrue it as dues receivable and record it as the revenue for dues. Now, if the person says, I'm going to pay 5 years because you're giving me a better annual fee if I pay 5 years of dues today, now we're going to record the receivable, but we're going to record the revenue to each year of which is applicable if we know if we know the following, that the dues not used yet could be refunded. So if I say I'm going to do a 5-year membership and then I decide to quit after 2 years, I will get 3 years back. Then we'll record the revenue over the 5 years. However, if I tell you I'm going to buy a 5-year membership, but it's sort of understood that if I quit, I don't get it back because it's really a fundraising gimmick, quote unquote. It's really a way of fundraising. How do I mean? Well, hey, show your real support. Become a member for the next 5. I'll do that. Time out. Show me how much you really want to support our organization. Do dues for 5 years now. So that's really a donation. It's just a donation gimmick. In that case, it's not refundable. The giver is not expecting to be able to get it back. Everyone understands it's a donation. So in that case, all that will be recorded in the year pledged. All will be recorded in the year pledged because it's a donation. So you'll record the dues of the membership over the period to which the dues pertain if, one, any part of it could be refundable. If not, it gets all recorded in the year pledged, and whether goods or services are provided. So if it's a membership situation and it could be refunded, but there's no goods to it, no services, it's really, again, fundraising, but it's a pledge that, hey, I'm going to pay you 5 years to help you with your budget, but I might not do it to all the 5 years. If I move, I'm not going to continue to do it. So it's not, and you're not, so it could be refundable. Or if I know that I'm not going to get it back, but you're not giving me anything in exchange, then it's really just a fundraising kind of concept. Again, think of Boy Scouts, the Boy Scouts of America. Become a 5-year member. Become a lifetime member. Well, I'm not giving you any service for your membership. Maybe you get a discount for our activities, but that's all you're really getting. It's just you're not getting a good, you're not getting a service. It's just a way to say show your support. So it's not. And in this case, maybe we would say if you move away, we would give you your part of your membership back. But since you're not getting goods or services, we're still going to recognize it all in the year that it's been promised or received. Any questions on that? Anybody? Because this is a little unusual in revenue recognition compared to for-profits. All right, let's see. Yeah, this sums up even better what I just said. So take a second to read through that. If the dues are non-refundable, and it could say and or no services or goods are provided, the revenue is just really a contribution, a donation. Now here it's adding one thing which I didn't say, and which is good, and that is if there's a real potential for refund, then dues should be recognized as revenue over the term of the membership, even if there are no goods or services. So this is clarifying the language from the prior slide, which I think is good to get clarified. It really works out like this. It's not an and or. If the dues are non-refundable and no services or goods, then you recognize everything when it's pledged or received, whichever sort of comes first. And then in the event that it's pledged, there are no goods and services, but there could be a refund, you're going to recognize the revenue when the refund period has expired, so to speak, just like you would with deferred revenue. However, this is not going to be deferred revenue. It's going to be revenue in support, one of the statement of activities, hitting the change in net assets. Not going to be recorded as a liability. Not this one, anyway. Well, I don't know about you, but I can't read this one. So let's see what it says. Let's blow it up a little bit. This, I think, hopefully will clarify this situation with membership. By the way, the reason why we're learning this is, again, many organizations have membership where it's mostly a vehicle for raising support, raising donations, but some membership organizations in the non-for-profit world are really just that. There's real membership, there's real goods or services being delivered for that membership, or it's really considered refundable. So there are different types of membership organizations. So let's see what this says. Fees for initiation or life membership raise same questions, obviously, regarding potential refunds or provisions of goods and services. If the fees are non-refundable and future costs will be covered by the receipt of future fees, let's see what this means. If the fees are non-refundable and future costs will be covered by the receipt of future fees, these fees will be recognized as revenue at the time they are recorded as receivables. In other words, this year's membership, which might be called a lifetime membership, is really a fundraiser for this year. We're not getting a lifetime membership from you today so that we can continue to exist 5 years from now, 10 years from now. It's really just show us how much you mean to us, or the opposite, show us how much we mean to you, give us a lifetime membership. It's a fundraising way, it's a way of getting more fundraising. And so therefore we're going to record all of it in the year we received it, because we're not expecting you to not donate in the future years. We're not expecting not to be able to get future donations in future years. It's not like we're getting a lifetime membership in order to exist for the next 10, 20, 30 years. So likewise, if these fees here in this sentence here, if these fees are needed to cover future costs, that's a different story. Then we should record those fees in the year we expected to use them and cover those future costs. Otherwise, record the whole thing in the year pledged, even if it's not received that year. And notice if it's a lifetime membership, we would recognize the fees to be received over the life expectancy of the individual. And if there's services or goods associated with the lifetime membership, we'll record the revenue as the goods or services are provided. So some really important parts to this slide, which is now on Canvas, by the way. And the real important parts are these two paragraphs. So you should zero in on the this concept of revenue recognition for goods and services. I'm not sure if this is effective line here, but it was a good idea, wasn't it? A little too thick. So if there's goods and services, then the revenue should be recognized when those goods or services are provided. If there's not goods or services, but the revenue of this fundraising, this lifetime fundraising, this pledge to be a lifetime member, that's in order for us to have money to be able to cover future costs, as it says here, future costs. Then this also should be recognized over the time period, the life expense, in this case, the life expectancy of the person, or any other reasonable measurement basis. With goods and services, it should be recognized when the goods or services are provided. Oops, that was not so good, but you get the idea. If it's goods or services, record it when those goods or services are provided. And if it's really just a fundraising, but we really do need the money in the future for the future years, and we're not expected to be able to raise money for the future, that's why we're doing a lifetime membership now, then you're going to record that revenue over the life expectancy of the individual. All right, we got a test question here now. Okay, so let's see if Socrative is ready. I'll get it ready for you. All right, now you can go for it. See what you come up with. Dues collected should be recognized as revenue when received if. All right, let's see what's going on there. Now we've got a complete picture. Let's see how you did. So we have almost a majority saying the dues are non-refundable is when the dues collected should be recognized as revenue, and that's exactly correct. Dues collected should be recognized as revenue when received if the dues are non-refundable. If the dues are refundable, that means that we are definitely going to, this is the principle we're learning here, we're definitely going to record that revenue over the time period where we could expect to maybe have a refund, maybe give out a refund. And so if it's refundable over 5 years, it'll be recognized over 5 years. But if it's non-refundable, we'll recognize it all in the whole year when received. And one last question before we take a short break. Let's see what this one says. I got to set up Socrative again, so hold on. There we go. You're all set. And the question is, which of the following is the proper accounting treatment for dues collected? And I think it's cut off. When a condition exists that prevents recognition of revenue at that time. Now, we haven't learned this yet, so this is again a good brain exercise to see what you do with it. Which of the following is the proper accounting treatment for dues collected when a condition exists that prevents recognition of revenue at that time? Well, sometimes maybe you're better off without me educating you, because it looks like just about everybody got it right, which is pretty amazing. Everybody got it right. Pretty good. Pretty good. You're using your newborn nonprofit statement of activities thinking. The answer is D, to record the dues as deferred revenue. You collected it, but there's a condition. All right, so let's take a break for a few minutes, and we'll come back and try to unravel some of this uh, material that we've been learning by learning it in a little bit of a different fashion. So I'm going to, if the clock here says 1:49 and 36, 37, 38 seconds, whatever, when it says, I'm going to give it a 5-minute break. So when it's 1:55, I'll be back. And if you have any questions, feel free to put it in the chat box. Okay, we're going to get started again. All right, we're going to get started again. And don't forget to mute your phone if there's background noise. But here we go. All right, so what I want to do now, I believe, let's see where we're holding. Yeah, let's do the following. Let's try to unravel some of the mystery of what we've been learning about revenue recognition. That's the the statement of activities itself. The format is not so difficult to get used to. A little bit of practice, and we'll have some. Will help you along. But the revenue recognition is a little bit unwieldy, so I've tried to decipher it in a way that maybe makes it a little bit more palatable. Let's go through how I've tried to do this. First of all, the transfer of resources to the organization is recorded. When it's recorded, how it's recorded, depends on whether the transfer is one of three different types of transfers. One is a contribution, which we're going to refer to as support revenue, helping the organization. Another type is an agency transaction, which doesn't happen all that often, but it could happen, and we'll learn. So since it could happen, and it does happen in certain occasions, we'll learn about it. And then the final one is an exchange transaction, and you can almost put in there the word revenue. So up at the top, when it says a contribution, you might want to say that's really support, and an exchange transaction is revenue. Now, GAAP defines a contribution, which is the first category, as this unconditional transfer of cash or other liabilities to a nonprofit entity in a voluntary non-reciprocal transfer by somebody else, meaning by an individual. And so it could be cash or other assets. What are the other assets? We know what cash is. Other assets include securities, land, buildings, use of facilities or utilities. We could give someone the use of a room free. We give materials. We give supplies. We could give the use of an intangible asset. We can give services, and these are unconditional promises to give those items either now or in the future. So that's how GAAP defines an unconditional transfer. And it also defines it as a settlement or cancellation of liability. So you could have had a situation where that refers to is you could have a situation where the nonprofit owes Office Depot for money, and Office Depot finds out through discussions with the nonprofit that they just don't have the money to pay, and Office Depot makes the decision to say, hey, forget about it, it's on the house. So initially it was a liability, but now it's been forgiven as a gift. And in the concept of contributions, sort of a subset, is there's two types of contributions that we can have. Well, before we get there, let's just define one. Let's summarize what we just learned. In a contribution, there's an unconditional promise to give that depends on the passage of time or demand for performance. That's where we get the idea of what we call temporary restrictions. And there's non-reciprocal. The idea of a contribution is it's non-reciprocal. There's nothing expected. There's no. The Latin term for this is quid pro quo. There's no quid pro quo. And they use the Latin or the legal phrase. Quid pro quo is a transaction where we expect something in return. Donations, contributions are not that. The conditions, so here's the deal. We learned in the initial phase of this concept is it's unconditional, but there can be conditional contributions. Those contributions could be donor-imposed conditions, or they could be restrictions. So there's two types of, quote, conditions that can happen. One we're going to call a condition. The other one we're going to call restriction, and how we record those will be different. So far we've had the idea that there's a contribution that's a non-reciprocal gift from somebody. There's nothing considered to be in return. The unconditional gift could have some, we said over here, could have a promise to give. Oh, okay, never mind. This is not temporary. This is not referring to temporary restrictions. We're getting there. Unconditional means a promise to give that depends on when I get to be able to give you the money, I'm going to give it to you, or when you do a certain action, then I'm going to give you the money. Uh, that's sort of the unconditional. I'm going to give you the money when you get up and running. I'm going to give you the money. But we have donor-imposed conditions. We have donor-imposed restrictions. Let's just see what these are about. So far, to summarize, we have basically an unconditional promise to give, and that uncondition can be also, since you have unconditional, can also be conditional contributions. All right, once again, so this slide was meant to be making it easier, and it's making it harder for me. So we'll do it one more time for good measure. We can have an unconditional promise to give something non-reciprocal, meaning I don't expect anything in return, and the entity is going to record it as a contribution upon receiving not the money, not the asset, but the unconditional promise. However, since there could be an unconditional promise, there could be conditional promises. So let's learn what they are. There also could be restrictions. So let's see what this is all about, and hopefully we'll put it all together. What are donor-imposed conditions? All right, a donor stipulates that a future and a uncertain event whose occurrence or failure to occur could happen gives the promisor a right of return of the assets it has transferred or releases the promisor from its obligation to transfer its assets. So what's this all mean? Let me give you a really good example. Well, maybe not a really good example. Let me give you an example. All right, so I might say to the organization, here's what I'm going to do. I'm going to give you $1,000 today. But here's the deal. I don't know if I can really afford $1,000. I'm going to give it to you today, but I'll let you know next December of 2017, or even better, I'll let you know in 2018, in December of 2018, whether I can afford to give you the whole $1,000. At the end of this year, 500 is good, but the other 500, I don't know what happens with that. Maybe I need that back. In the meantime, here, take the money. Or I just make a promise that I'm going to give you 500 this year, and I'll give you 500 next year, but I'm not sure I'll be able to do it. So don't consider it an absolute promise. So it gives me the right to either have the assets returned, that's number one, or have the organization release me from my promise because of my condition. My condition was, I don't know if I can do it. Or I'll do it if so-and-so gives me money. If A gives me money, then I'll give you money. So if A gives it to me, then I'll give it to you. So that's a condition. So the organization doesn't know for sure that it's going to get it because of the condition. How do we record that? Well, the fact that it's a condition creates uncertainty about whether the organization will ultimately receive it or be able to keep it. And because of that uncertainty, the organization should substantially meet the uncertainty that the organization should substantially meet all donor-imposed conditions before recognizing the receipt of the assets as a contribution. Because of this uncertainty, the organization should, I think the word substantially shouldn't be in there. Because of this uncertainty, the organization that might be met, all donor-imposed conditions before recognizing the receipt of the asset as contribution. The English got corrupted there. My apologies. What did I mean to say? I meant because of the uncertainty of the fact that the conditions will be met, the organization should not record it as a contribution. So where is it going to go? As refundable advances. What do we call that in accounting? What did you call that in, let's say, intermediate accounting? And David's giving it a try, so we'll see what he does. I think he's giving it a try. Yeah, that's exactly right. Deferred revenue. That's exactly right. So that it's a condition, but maybe it's not going to happen. So I can't record it, meaning the organization cannot record it in its change of net assets until the conditions are met, until they have been substantially met. Now, the rules go a little bit further in order to avoid manipulation of when revenue gets recorded. Look, if it's some type of donor-imposed condition that is really remote, then let's face the facts. It's a contribution. I might say, I'm going to give you $10,000 when President Trump, I'm going to give you this $10,000, but if President Trump resigns, I want my money back. All right, so that would not be considered, well, that may not be a great example, but I think you got the idea. In other words, if it's very unlikely that the condition is going to happen, and everybody knows that, so then it should be recorded. So I guess the best example, not that this is a real life example, but I might, you know me from class. So if I say to your organization, I'm going to give you $10,000, but if I grow 5 more inches, I need the money back. So I got to get a whole new wardrobe of clothes. Well, that's crazy, right? So that's not happening. So when I tell you that, it's not really a condition. It's just sort of it's words. It has no meaning. Now, this is different than a donor-imposed restriction. That's not a condition. That's a restriction. A restriction of the organization. You must do this. You must do that with my money. Are you going to do it now? You're going to do it later. You're going to do this. That's where we get into the temporary restricted assets. Now I think we have a pretty good handle on that. Unconditional contributions, where there's no conditions and it's without restrictions. That's easy. Unrestricted support. Notice the word support, unrestricted support. That's the concept of using that word as opposed to revenue. Support being the key, supporting the organization. It's a contribution to help the organization at large. Unconditional contributions with donor-imposed restrictions. All right, that's temporary restricted support. That we understand. It could be permanent if it's going to be an endowment, or more likely it'd be temporary restricted. Endowments do happen, so it could be either or. And then how do you know which is which? It depends on the nature of the restriction. Permanent is don't spend this money. That's it. Temporary is spend this money when you get finished making that movie. When you get finished making the movie, then it's yours. So use the money to make the movie. All right. Recognizing and classifying contributions. Let's see what this is about. Conditions govern when a contribution is recognized. Restrictions govern how. So conditions govern when a contribution is recognized, because if the condition's still outstanding and it could happen, it's deferred revenue, as David said. When that condition goes away and it's been satisfied, then it's recorded as a contribution. If it's a restriction, it's recorded as a contribution in the beginning, but where do you record it? How do you record it? Temporary, unrestricted, or permanently restricted? Well, that concludes contributions. Let's turn to agency transactions. Agency transactions are where the nonprofit simply acts as an agent, trustee, or intermediary. It's going to record the monies it's receiving as a liability or an asset. Well, it will record as an asset receiving cash or property, and to record the credit as a liability. It will not put it on the statement of activities. It's merely a flow through. That example we gave in class is I'm collecting for Hurricane Sandy's victims. Give me whatever you give me, I'll pass along to the Red Cross. I'm acting as an agent for the Red Cross. So an agency, I will have no discretion. I must take the assets and give it to whom I promise that I will give it to. That's an agency relationship. I promise that if you give me money and you tell me you're giving it to me for this reason, it'll go for that reason. So I promise, give me money and I'm going to send it to a church in South Africa, and you give me the money and say, here, give it to the church in South Africa. That's an agency relationship. It's not revenue to me. I'm going to simply follow your instructions and send it to the church in South Africa. All right, that concludes agency transactions. Now we get to exchange transactions, which is, like it sounds, unlike the contribution where there was no reciprocity, no reciprocal part to the transaction. This has an exchange element to it, which is going to look just like a for-profit world, but it's in a nonprofit environment. So these are reciprocal transfers. You give me something, you expect to get something back. And what you expect to get back should be of approximate equal value, because if it's not expected to be of equal value, then there's a hybrid going on where there's part of the transaction is a contribution and part of it is an exchange transaction. So again, if you give me $100 and you know you're going to get $50 in value, well, you knew in your heart that you're only going to get $50 back in value, so it's really $50 was given to me with the idea that you're going to get $50 of value, and the other 50 was a contribution to me. So that's a hybrid. Here's a slide that gives you lots of small print. We'll blow it up a little bit, see if it's readable. I'm not going to go through every line item here, but this is a really good summarization of the difference between exchange transactions and contribution transactions. Let's just take a look at, let's look at the fourth line down. On the exchange side, it says the grant payment, if it's a grant, represents the cost of goods services to be received by the grantor, or cost plus some markup or profit margin that might be involved as well, that the grantor expects the nonprofit to, quote, charge in order to manage overhead and build up resources and surplus. On the contribution side of that same idea, the grant proceeds are stated at a flat amount with the intent of subsidizing the organization's cost of providing the goods or services, or both. So let's summarize this fourth line down in a little bit more detail. And that is, typically grants are given with the idea to cover the costs of the goods or services that the grant expects the organization to provide, either to the grantor or to the public. And they don't expect the organization to have a profit margin, a profit motive, but they might give the organization a little bit in order to build up some surplus for the future days ahead. But it'll be cost plus whatever surplus the granting organization decides to give to the organization. So that is giving to the, on the exchange transaction side, giving to the nonprofit organization to do good, to do services, to do something, and with the idea that they're going to pay you based on what you do. So the grant is going to be paid on what you do and how much you spend on it. That's the idea. Take a look again at the language. It represents the cost of the goods services to be received by the grantor, or so as grantor in this case could be Medicaid, paying for services in a nursing home, for example. So it pays for the services in the nursing home for a patient that Medicaid puts into the nursing home, an individual who needs to be there, and the organization is going to provide those services, but they will only provide those services based on the cost incurred. So whatever the grant allows the organization to make, quote unquote, meaning the cost plus, that's the limit of how much they can make. They could get really clever and spend less money to provide the service, but the grantor will only give them the cost of the service plus the allowed surplus, if there is an allowed surplus. That's on the exchange transaction side. On the contribution side, the grant would be flat. And so if the organization can provide the goods or services and build up more surplus than maybe was otherwise anticipated, they win. So it's just a flat amount. And so there's an element of a contribution to that. So it's just a grant. Here, take this money and do good things with it. Run programs, run this program. That's a contribution. On the left side, it's here, take this money if you spend money to do good. On the other side, under contributions, take this money and do good. It's a little subtle, but we should go through each of the lines and make sure you see the difference between exchange transaction versus contribution. Let's try one more. Let's look at the next to last line where it says the grantor determines, under exchange transaction, it says the grantor determines how-tos, meaning how it should be done, how the goods to be or services to be provided. So the grantor in their grant will say, do this, and this is how we want you to do it. That's an exchange transaction. It's telling the organization what to do. As to under the contribution side on the same line, the grantor expresses the goal of the activity rather than how to do it. So on the left side, if it's feed the homeless, the grantor might say for an exchange transaction, I'm going to give you $50 for each meal you provide to these people under these conditions at this place in this city, in the inner city, wherever it is. And the right-hand side would be, here's a block grant of $100,000. Go out and feed the hungry. Figure it out. Do the best you can. So one's an exchange transaction where there's an expectation of a certain action and maybe a certain amount of money spent as well. Whereas on the right-hand side, it's sort of do the best you can. On the left-hand side, the grantors will often require an audit where they want to see exactly what you did, because it's an exchange transaction and they expect to get their money's worth. Whereas on the right-hand side, there can be audits, there can be strings attached to see how you did, but that would be more for determining whether they're going to renew the grant or increase the grant or cancel the grant in future years. That's what that would be on the contribution side. On the left-hand side, it would be, if you didn't spend the money the way we thought you were spending it, we want it back. Or if the service that you gave was inferior or the goods you gave were inferior, we want our money back. So there are repercussions with an exchange transaction, just like there is in business exchange transactions. Whereas on the contribution side, where there may be repercussions, they're not the same. The repercussions are more future-oriented. I'm not giving you money anymore. All right, let's get this in line a little bit. All right, so we have a few examples to go through. A donor makes a contribution to an organization and includes a condition that an annual financial report has to be filed. Would you record this as a exchange transaction or a contribution transaction? So rather than go to Socrative, well, we could. Let's see if we could do that. Hold on a second. I have to change the parameters. Don't answer yet because I might have to set up as true false. Let's see. All right, so I set up an answer for true false. Let's do a couple of these, see if you got the idea. Should it be recorded as a contribution, true or false? So see what you do with that. The contributions has one condition. You got to file an annual financial report. Is that an exchange transaction or a contribution transaction? Let's see how you're doing. Nobody's doing anything. Okay. Oh, we got one student who tried. Got another one. Okay, keep going. Maybe you lost the. Okay, very good. So everyone's answering true. It's a contribution, and that's right. So you're starting to get the idea. All right, it's not bad. I think this way of looking at it in this slide presentation helps take some of the mystery out of it. Let's try this one. True or false? Should this be recorded as contribution revenue? True or false? What is it? A prospective donor promises to contribute $1 for every dollar of contributions received by your non-for-profit organization, up to $100,000 over the next 6 months. I have to set up Socrative again, I know. So wait a second. There we go. Now you can answer true, false. Is it a contribution or is it an exchange? So if it's a contribution, the answer would be true. I see what you did, Esther. Did you just do that, Esther? Okay, we'll straight. Was that for this question or the last question? All right. While Esther's typing, let me tell you that the answer to this question is it's true. It is a contribution because it's true there's a condition, but it's not an exchange. They're not getting anything out of it. What they're doing is they're giving you. Okay, that's good, Esther. Thank you. This is a conditional promise, and so if the condition's met, you get money, but it's not with the expectation of goods or services. So it's definitely a contribution. All right, yeah, okay. The first question we had before I set up Socrative again, just to go back for Esther, an annual financial report, yeah, that's a requirement, but that's not a good or service. That's not goods or services. So it's not an exchange. I'm not buying a financial report. It's just saying that I'm going to make you a contribution, but I want to see the financial report. That's what it is. All right, let's see. Hopefully I didn't lose anybody here. I think we're still on the line. I got to get my screen up though. All right, let's try the next one. Let me clear the board for Socrative. We'll do a couple more of these as much as time allows. We'll do a few more. So I got a new setup of a true-false question for you there, and here's the next question. A prospective donor promises to contribute $1. Is that the one we just had? Yes. Let's go here. Here's the new one. Prospective donor promises to donate $100,000 that must be used for Program B if the non-for-profit raises $100,000. Is that a contribution or is that an exchange transaction? True, false. If it's a contribution, it's true. If it's not, it's false. So see what you do with that. All right, and we'll explain that for you, Esther. You're not on the Socrative, that's okay. Everyone on the Socrative side answered it is true. It's a contribution, and they are correct. And here's why. It's good that you make the mistake, Esther, because you're helping everybody learn. That's the following. The prospective donor promises to donate. There's a key word. I'm going to donate. And you'll have to use it for Program B. Yeah, it's a donation, and it's going to be restricted. It's going to be a restricted donation. It's got to be for Program B, and there's a condition. So here you see both. There's a condition, and there's a restriction. The condition is the not-for-profit has to raise $100,000, and then they get a donation, and it's restricted. But nevertheless, the donor is never expecting to get to themselves services or goods. What they're expecting is this is what you're going to do with the money, and I'm going to give it to you if you do this. But it's never something that's going to help the donor. It's only a condition in behalf of the nonprofit organization. It's not something that actually goes to the donor. The donor doesn't get the $100,000 they raise. So there's no goods or services to the donor. So that it is a contribution. All right, let's do a few more. I'm going to set up another true-false question, and we'll try our hands at another one. Let's see what's next. Here's a donor makes a contribution to a not-for-profit organization whose mission is to help the homeless. The donor says that the funds must be used to help the homeless. All right, so what do we got? Is this a contribution that's unrestricted or temporarily restricted? So now that doesn't work too well with the true-false, so let's set the parameters. Is the contribution unrestricted, true or false? Is the contribution unrestricted or temporary? True. Is it true or false? Is the contribution unrestricted? Because if it's false, then it's temporary restricted. So let's see what we're doing on the line. We're saying we've got the majority of people. Not everybody, but most people are saying it's false, which means it's not unrestricted. And I think that's true. I think it's temporary restricted. The funds must be used to help the homeless. So in the event that they didn't use it to help the homeless, well, they didn't fulfill the restriction. It's only temporary because they're supposed to use the money, but I think it's arguably temporarily restricted. It could go the other way. I mean, we don't have a whole lot of facts here on how the donor made the statement. Suppose the donor just said, look, your job is to help the homeless. Here's money. Go help the homeless. There's a good argument that it's unrestricted because that's what the organization does as a whole. It's not like saying use this to help these homeless people over here, or use this for this program of yours. So I think we may need a little more facts. The way it says it right here is I would vote that it's unrestricted. I would say it's unrestricted because that's our job is to help the homeless, and it's like, here, help the homeless, take the money, help the homeless. So it could be used for anything we want for our mission. We can't do anything else except help the homeless. That's our mission, but I don't think it's restricted. Yes, Esther, that's correct. Once the contribution is not beneficial to the donor, and there's nothing he's getting back, that's a contribution as opposed to an exchange transaction. That's very good. You got it. The rain in Spain falls mainly on the plain. You got it. Let me set up Socrative over again. Let's try another one. I think we're seeing that these aren't so cut and dry all the time. They can get a little tricky. Let's try another one. Let's see. Donor makes a contribution to a not-for-profit organization. That's the same one we just had, isn't it? No, it's different. Here we go. It's the same organization. It's a homeless organization. The donor stipulates that the contribution is to be used for purchasing playground equipment. Now what do we have? Is this unrestricted? True or false? Is it unrestricted? I bet you everybody gets this one. You better get it. I'm waiting to see what you get. You got half the answers in now. See what you can do more. All right, everybody got it. It is temporarily restricted. Now you can see why the first question before this, now you can see the difference. Here the person says, use the money to buy playground equipment. That's it, nothing else. Buy the equipment for the day camp. In this one it said, use it to help the homeless. That's too wide open. There's no real restriction on that. That's unrestricted. Here there's a restriction. Here there's restriction. Good job, Esther. Good job, class. All right, let me set up Socrative again, and we'll go for it. Let's see. Next question. Nonprofit organization, they have a contract with a local government to provide preschool services for a certain number of children for a fixed number of hours per day for a fixed period of time, assuming that the rate paid per hour per child is reasonable. Is this a contribution, true or false? So it's with the government to provide preschool services. Is this an exchange transaction or is it a contribution? And Esther's doing a great job because she's going to really help the class learn. Let's see what the other students are doing, and then I'll show why she's helping out. And our student body is saying that it is false, not by an overwhelming majority, but almost by a pretty good majority, that it is an exchange transaction. It's not a contribution. And Esther's probably screaming, how can that be? You told me. So here's the thing. We have to look through it even a little step further. The nonprofit is doing a contract for a local government. What's the government want? They want preschool services for the children in the jurisdiction of the government, that local government. So maybe let's say it's Prince George's County. Prince George's County wants preschool services for their citizens of the county. And so they're paying this preschool to give those services. So maybe you could argue Prince George's County is not getting anything to themselves, but they are getting a service that they want for their citizens. So there is an exchange transaction. There's an expectation of you're going to give preschool services to our citizens, and this is how much we're going to pay you to do that. So that's an exchange transaction. A little confusing because it's not reciprocal directly to people in the government, but it is reciprocal to the government who's trying to help their citizens. If the organization didn't do it, the government would have to do it themselves. All right, let's clear the deck over on the Socrative, and let's try another one. Here we go. Next question. Preschool receives a grant from a private foundation to study the effect of children attending preschool on the children's future performance in school. The results of the study may be published by the preschool. Is this a contribution or an exchange transaction? It's a good question. So if it's a contribution, true or false? Is it a contribution or false? And we got not the overwhelming majority, but we got the majority coming in saying it's a contribution. And Esther, I don't blame you for not answering. um, it's a contribution because it's true. There's a study that's going to be done, but this is not it is a contribution that's temporarily restricted. That's true too, but it is not an exchange transaction. This is not a exchange of give me a service, give me a good. This is we want to do something good. Here's what I want you to do. Here's the good I want you to do. That's what my money's for. So there's a temporary restriction, but it's not like a business transaction. Before, the local government was getting a business transaction. They were getting their residents of their local area taken care of. Here, they're getting a study done. The private foundation is getting a study done. So it's again. Let's try another one. I think I cleared the deck on Socrative. Not yet. I'm going to clear it now. Let's try this one for size. See if we can get through the rest of these, and we'll have call it a day. Not-for-profit organization is a gift shop. Sells items related to the organization's mission. Is this a contribution or exchange transaction? So if it's a contribution, true. If it's not a contribution, false. And maybe the way to answer the question is, are there goods and services? Are there goods and services? So let's see how we did. And the answer is everybody came up with false, and that is correct. It is not a contribution because there are goods and services. To help along, maybe Esther, to distinguish here, there aren't goods or services. This is it's not a service to the private foundation. It's not goods to the private foundations. It's a service for the good of the world. It's a service for the good of the community to do the study. So it's part of. It's not a good or service in the business sense. Subtle, maybe. All right, definitely. In some cases, very subtle. All right, let's try another one. Let's go to the next question. Oh, more information this time. ABC company gives 50,000 cash to an opera company for the support of a show. In addition to acknowledgement in the opera brochure, the opera company provides ABC with 1,000 tickets to the opera. The fair value is $10,000. And there's a dinner for the officers and directors of ABC company with a fair value of $8,000. Is this an exchange? Or rather, is this a contribution or exchange? So contribution, true or false? Is it a contribution transaction, true or false? And so we have a majority saying it's not a contribution, and they're saying false. Esther says false, and it's a tough question. What's the fair value of what they've got in tickets? $10,000. What do they give? $50,000. Well, I don't spend $50,000 to buy $10,000 of tickets every day. If I did that every day, I'd be broke. So I would do it if I'm a philanthropist and I'm trying to help the opera company. So this transaction arguably is a hybrid. There is a contribution element to it to the tune of at least the $40,000, or at the most the $40,000. Maybe arguably a little less because of the dinner. The dinner might be considered a fundraising event. So you might want to make the argument that to the extent of $32,000, meaning 50 minus the 18 for the value of the dinner and the tickets, maybe that's the contribution is 32,000, but for sure there's an exchange transaction also going on because it's a significant amount of tickets given to ABC company. So that's definitely a hybrid, and there is no right or wrong answer to that. So everybody got it right. Isn't that cool? All right, let me set the deck. Let's try another. We're almost there. I think we can make it. ABC company is headquartered near a large university and would like to have a new building named after the company. So they agree to pay $3 million to have its name posted on all 4 sides with its logo for a minimum of 5 years. No other name can be displayed. Is this a contribution or exchange transaction? True, it's a contribution. And people are, oh, we got a right. Ooh, we got 2/3 are saying it's false, that it is not a contribution, it's an exchange. Esther even says it's false, I think, here. But really, this is more likely a contribution. It's true they're getting their name displayed, but they're not getting their name displayed in an advertising sense, where its name is showing up with the best company in the world, or the best product, or the best service. There's just their name. So it's really a fundraising type of a deal, and it really is a contribution transaction. You can see these are not, well, I'm now learning they're not as easy as I thought they were. God, I've been doing this a long time. So for me, it's very easy, not very easy, but it's, I can see the issues here. Let's try another. I think we're done. How do you like that? Yep, we're done. Oh, yeah, we're done. We have one last thing to do, and then we're really done. Edward, I appreciate that. I'll try to unconfuse you in 1 second, so just hang on. One thing I want to let you know is you may have had in your intermediate class, or you will have it, there's new revenue recognition guidelines for both for-profit and non-profit when there's exchange transactions, but it's not going to affect nonprofits all that much because it's only certain types of exchange transactions that should affect the nonprofits. But the main point is to know that the new revenue recognition guidelines for, generally speaking, the for-profit world do affect nonprofits when it's in a particular type of exchange transaction. So that's that. Now, I'll tell you what, hang on, and let me see if I can unravel just a little bit. I'm not sure I can, but I'm going to try. So the issue is we have a contribution, no goods or service to the benefit, let's put it that way, of the contributor. That's a contribution. A exchange is benefit in terms of goods and services. So to use some of the examples we had, the government that gave money for purposes of a nonprofit to provide daycare to its residents that live in the government, they were getting something that benefits them. They're the contributor, and they're getting a benefit. And the benefit is their residents get to go to a preschool program. The company that gave money to the university to have their name put on a building, they're not really getting advertising. It's not truly advertising. All right, you might argue that there is some advertising element to it. So maybe you're right. Maybe it's a hybrid. They're paying much more than they would normally pay for that kind of advertising. They could certainly do better by advertising in ways other than that and saving their money for better types of advertising. So this is a hybrid, perhaps. Maybe there is an element of they're getting the good or service of the actual advertising, but it's more than the fair value of that type of advertising is what they're giving. So it could be a hybrid situation, and that's what I think can make this confusing. The last question has a condition to the yes, there could be conditions in the contribution. There can be restrictions in the contribution. But determine whether it's a contribution or exchange transaction is a separate decision. Let's see, Esther writes something for the name display and no other name. Yes, okay. Okay, so fine. So you might say what Esther's saying, that's very good, Esther. That's actually very good. What Esther's saying is, since the name's got to be there for 5 years, you might say that they have to recognize the revenue over the 5-year period. They might have to recognize the contribution revenue over the 5 period, and I think that may be correct. I think that may be absolutely correct because the name has to stay up there for 5 years, and should the name come down, probably written in the contract is the ABC company would get their money back. I'm pretty sure they would certainly have the contract that way. The grant or the money going to the university would certainly say that, and so Esther's correct. That would be revenue that would be recognized as contribution revenue, but over the 5-year period. So that's very good. And so let's sum that up one more time. The universities gets this contribution above the fair value of what advertising really should cost, but since it's over 5 years, that's a condition. And while it's not a restriction, it's a condition, so the revenue won't be recognized until during the period of as the years go by. And I think that's great to sum it up now and say we call it a day. And I'll be back at you with some information. We're going to have some homework assignments coming up, so stay tuned. I'm going to stop the recording. If anybody has any last minute comments,